in the second half of the course. Let me start then. So like when you go to museum, there are a lot of different pictures, but usually you have a short time and there you cannot spend much time on looking at all of them. And this is why you use the services of the guide who walks with you along the gallery and shows the things that worth mentioning and highlighting. And this is kind of the things that we will do with you today. We will walk along all slides that we have, starting from the topic 7, portfolio theory and capital asset pricing model, discussing some of the focal points in each topic that are more likely for you to be met in the final exam, and as well as in your practical career in the subsequent topics and subsequent subjects that have a corporate finance as a prerequisite. So this is the plan for today. So the kind of excursion. We'll go by each of those lectures that we have. So we will have eight lectures to cover. Of course, we won't be able to have all the material completely because each of them took one full class. But we will cover some of the things that worth highlighting. The first 6 topics were included in your midterm exam. Therefore, we will not include them here in the final exam. We start from the topic number 7. So, portfolio theory and capital asset pricing model. Yeah, I think you should see now the slides. Yeah, and I have a question from Amir Arsalan. Please.
Yes, hello. Just wanted to ask you, did you just mention that we will only have topic 7 to from topic 7 in the final exam and not the previous lectures, or we will have them?
Yes. So you had the midterm that covered those topics, first 6, and other 8 are covered in the final exam.
Okay, so we will not have anything from the first. So we will not have anything from the first 6.
Yes, but no, as we discussed, this is some of the idea that we meet frequently in the course, that all the subsequent topics are based on the first one. So, of course, you will need to do some discounting, or you should know what types of securities we have. So those kinds of things, what we mean by risk and return, volatility, standard deviation. So I cannot say that you can forget everything now. At least wait for the end of the course. But technically speaking, yes. So the topics are starting from the topic 7.
Great, thank you.
Yes, you're welcome. So the portfolio theory and the capital asset pricing model. Here in this topic, we discussed the idea of diversification applied on the investment portfolio, how we can link risk and return, and this is arguably one of the most famous model in the corporate finance, and therefore we have to pay some attention to it.
Excuse me, but no one can connect to the meeting right now.
What? No one can?
Connect to the meeting right now. There is no access.
How come? There are some people joining now. I didn't change any settings here. And now? So
I'm sorry, I just joined, but it was like via the link. My group mates sent me the link, and only in this way I could join.
Maybe there is some update in Microsoft Teams. What we can do here. So there is no meeting in the group, or what happened?
Yeah, there is like it just stated that the recording started and the meeting started, but the button to join there is no.
Is absent.
Mm-hmm.
Maybe I will look for the link, invitation link. So could I ask you to post this link in the group chat? No, in this team, some of you, to invite people. Sure. I saw someone posted. Yeah, now it goes better, so we have more people joining. Good. Okay, seems like we settled that. Yes, thank you, guys. Let's move on. In the chat in VK. Good. So there was multiple ideas that we discussed there, including the idea of efficient portfolios. By efficient portfolios, we meant that the set of combinations of different assets that provide the highest return for any given level of risk. And the important principle there, an important factor that determines what would be the results of the diversification is the correlation coefficient. So there are some assets that correlate strongly with each other, and then combining them together will not provide us any substantial reduction in the risk. But if those assets are not correlated with each other, so if price of one asset goes up, price of another asset tend to goes down, it makes our portfolio more resilient and it is less likely to fluctuate more. And depending on the correlation coefficient, portfolios would be different in terms of their dependence on the, in terms of the diversification, in terms of their risk. We started by discussing the combination of the two assets. In this case, there were stocks of Johnson & Johnson and Ford. They have some expected return, they have some standard deviation, and the lines here, the blue line represents the return and standard deviation of this portfolio under different fraction of each asset. So this is the bottom one where we have Johnson & Johnson. It means that the 100% of assets are invested in one stock of Johnson & Johnson. And naturally, the expected return and standard deviation of such portfolio would be the same as the one for these assets. On the other side of the line, there is a point where we invested everything in Ford, and therefore the standard deviation and return is the same. And all the points on the line in between, they present the different fraction of these assets into the portfolio. And there is, we have yellow line. The yellow line is the case when the assets are perfectly correlated. When the assets are perfectly correlated, we do not have any additional reduction in the risk by combining the assets, and therefore the risk and return would be a linear function of the fraction of the assets in the portfolio. Another radical case, another extreme case, is the situation then there is a perfect negative correlation between those two assets, and this case is presented with a dotted red line. If the assets are perfectly negatively correlated, we can put them in a proportion when the risk, as the one risk that we mentioned in the standard deviation, gets to 0. Yeah, so both of those cases, like perfect positive correlation and perfect negative correlation, they are unlikely to be presented in real life. Perfect positive correlation might be done artificially. Then some assets are just technically attached, the price of some assets technically attached to the price of another asset. Then they will be perfectly correlated. But if we talk about assets that are traded on the open market, it is unlikely to happen. And perfect negative correlation the same. But these cases are important to present the tendencies. And there are a lot of assets that are substantially correlated and some assets that are substantially negatively correlated. And this is important for us. Then we combine the portfolio in order to estimate the effect of diversification. Here I present, here on the top of the slide, you have a general formula to estimate the portfolio variance, which is a squared standard deviation of the two assets. And this formula is important for us to illustrate the effect of correlation, as we have this rho variable, and we have 3 special cases here of the perfect positive, perfect negative correlation, and the absence of correlation, perfect absence of correlation. For them, we have shorter versions of such formulas. And rho variable is crucial here because it determines the effect of diversification that we can achieve. In general case, we used the table in order to estimate the variance of the portfolio of more than 2 assets. But the logic is the same. We have the fraction of each asset and their covariance with each other, and we find the sum of all of those assets in order to estimate the variance of this portfolio. Alternatively, what you did in your first homework, also you can do it by combining, by just estimate the price of the portfolio in different time period and have and estimate variance of this price of the portfolio. Here we illustrate on the point of the additional efficient frontier. So first we combine 2 stocks with each other in different fractions of each asset, and then we reach this red line. Then we add 1 more stock, and we can each beta point. Beta in the terms that we would have lower risk for the same return or higher return for the same risk, it means the better portfolio for us. And naturally, we want to get further to the right side because those are the best portfolios. Highest risk, lowest return. We eventually, by combining all the available portfolios that are available on the market, we reach the level of efficient frontier. This is the fat line on this chart, represent the efficient frontier. Here we have the set of stocks and the fraction of each stocks in the portfolio here. So when we mean stock A, we have some distribution of the assets. So the portfolio with the lowest standard deviation would be the mixture of multiple portfolios because we combine uncorrelated assets and can reduce the standard deviation of the portfolio. And portfolio with the highest return would be the portfolio, then we just invest everything to the assets that has highest return. In this case, it was the 4. All other dots, they present each of the individual stocks. And we see that by combining them together, we can achieve better results. Then was the next step that we considered, that we can not just choose some risky assets, but we can combine them with the risk-free assets to achieve even better portfolios. And how we estimate the results of this better portfolio, we had a market portfolio, we had an efficient frontier, so the optimal combination of the risky assets in different proportion. And we have a risk-free rate. Risk-free rate is the rate on the treasury bills. And then we draw the straight line from the risk-free return, so the point of some return with a 0 level of risk. We draw the straight line from there, and there is a single tangent point for this line. And this tangent point we call the market portfolio. And in order to achieve the better portfolios, we can either lend some money. Lending means buying treasury bills, and borrowing, in this case, meaning borrow money to buy more risky assets, to invest into the market portfolio, to invest in the assets in the proportions which are in this point here on the chart. And by this set of combinations, we achieve better results, and all those results are plotted along the straight blue line, which is called the security market line. Here we have an example on the different fractions. So we can, if we invest everything in a risk-free asset, we'll be in the point A. If we invest half of the asset in a risky asset, half of the assets in the treasury bills, will be somewhere in the point B. And you see that point B is better than its alternative on the efficient frontier because we might have lower risk for the same return. So comparing this one. Do you guys see the cursor or not?
Yes, we do.
You do, yeah? Yes?
Yes.
Yes. Yes, thank you. So here point B is better because it has lower risk for the same level of return. And if you are very risky, instead of investing in the most risky assets available, you can borrow some money and buy the market portfolio. That might be the better option, and this is something that presented on the point D. We have an assumption of this model which result in a limitation of its use. The assumption is that we assume that we can borrow at the same interest rate as the one we lend the money on the open market. And here, this rate is the one that equal to the risk-free rate. Yeah, so here we discuss how to determine the points on this line. As we combine risky asset and risk-free assets, the risk will be determined by the fraction of the risky assets in the portfolio. And another estimate that we discussed in that topic was the Sharpe ratio. It is additional risk premium, additional return that we receive for having more risk. And this characterizes the slope of the efficient frontier. As security market line, in order to draw it, the slope of this line is determined by the capital asset pricing model formula. The higher the beta coefficient, the more the steeper would be the line. So for the more risky assets, we might have higher risk and the higher return. And the principle of this model is that instead of investing into the single stock, rational investors would rather invest into the portfolio of stocks. Therefore, the demand for some individual stocks will go down, and their return, demand go down, price go down, and the expected return goes up. And as a result, the stock prices adjust in a way that their return would be plotted along the security market line, depending on their sensitivity to the market return, which is determined by the beta coefficient. This is the idea of the capital asset pricing model, the one that we use in order to estimate the return of the stocks. Yes, so this is something that there are multiple assumptions of the CAM. As most of the models, it is not perfect description of the reality, but it's important because it characterizes one important interrelation between risk return and the systemic risk. So the sensitivity to the changes on the open market, yes. And as we just proved that we can estimate the return with the capital asset pricing model, this is something that is very popular in order to predict the return of the stocks. So in order to do that, we need just the beta coefficient, risk-free rate, and the market return. So the only individual feature of the stock there would be the beta coefficient, because the market return and the risk-free rate, they would be the same for all other stocks. Yes, and there are some alternative ways of predicting the stock price. The general approach there would be arbitrage pricing theory. This is something that you can practice in your term papers or final theses. You can suggest your own models for predicting the return by different factors. In capital asset pricing model, we use only one factor, is the market return, but here you can have different factors. There are some well-established models of the arbitrage pricing theory, but you can come up with other alternatives. And the principle there that we built the model, the regression model, in a basic form. It would be linear regression model, but you can go further and try to predict with the multiple factors. But as the most important one is the market premium, and it is reflected in the capital asset pricing model. But there are some alternatives as well that includes multiple other factors. Yes, there is this three-factor model, which is a quite well-established one among arbitrage pricing theory models that have market factor, the same one that we have in the capital asset pricing model, plus factor of the size of the firm, that it is usually the smaller firms grow faster than the bigger one, and the book to market ratio, so the ratio between the stock price, capitalization of the assets and balance value of these assets. So here are examples of the estimating of the return by the three-factor models. Good. This one is we completed topic 8. You can. Let's move further to the. We completed topic 7. Let's move on to the topic 8, risk and the cost of capital. We started at 13. So I will need to accelerate a little bit. You will have a recording of this lecture as all previous lectures. So if we go too fast, you can revisit it to try to understand it again. Here is the risk of and the cost of capital. In this topic, we analyze the project risk, the cost of capital, and also some alternatives of adjusting the project for the risk. Because as we discussed, more risky projects should have higher return, and therefore in our discounting strategy, we should consider the riskiness of the project in order to have adequate estimation of the net present value of such projects. We started with the value additivity principle, as the company can be considered as a sum of the projects that this company work on, and each of them in the perfect situation should be discounted in the appropriate discount rate, and sum of those discounted value will be the value of the company as a whole. Company, depending on its capital structure, can set the cost of capital, because both equity capital and debt, they are not free for the firm. Firm pays dividend for equity capital, and also there is an opportunity cost of capital for its own capital that we also consider. And for the debt, we pay interest rate. Here we have some formulas of the cost of the basic formulas of the cost of capital. Then we will move further to discuss the weighted average cost of capital. By default, the weighted average cost of capital would include also the tax shield. In this case, in cost of capital we have only the fraction of the debt and equity, but quite frequently the cost of capital and the weighted average cost of capital, they are used interchangeably, and in our final thesis, in our final exam, we will, if it's not mentioned alternatively, we mean weighted average cost of capital, and you should consider the taxes where relevant. Importantly, that here we work with the market value of the debt and equity, not with the balance value of that. As a return on debt, we use the yield to maturity of the bonds. So the bonds are the securities that represent the debt obligation of the firm. And for the equity, return on equity, we start from the capital asset pricing model that present the expected return for the assets of such risk. And important adjustment that we do to this, here we illustrate the principle that the total cost of capital of the firm is the weighted average of the costs of debt and equity. Then at this step we have to make adjustment due to the fact that debt is a tax deductible. The more interest you pay, the less profit you would have, and therefore the less taxes you will need to pay. Alternatively, the cost of equity, they are either considered as opportunity cost of capital, or as if we talk about the direct costs of equity, those would be dividend, but dividend paid after the taxes, after the corporate taxes. And therefore, we do not have the tax shield here, but we have it there in this part, in the part that stands for the cost of debt. Here is an example. For the tax shield, we use the rate of the corporate income tax. In Russia, it is 20%. In other countries, that might be different. So use the rate of the country where the firm operates. So this is how we would estimate the equity, return on equity, capital asset pricing model, estimate with a beta coefficient. So here are some historical data on the beta estimation. No, beta is a just linear regression coefficient, and how we characterize it. But but beta means the change in the market premium for 1% results in a beta percent change in the assets that we consider. And also, in order to make some more reliable estimation, instead of some discrete variable of the return, we can use the range. For example, by adding or subtracting standard error, then we would say that with a probability of 95.4%, we expect the return to be in those range. Usually stable, and then what we can do, we can re-estimate the beta coefficient for the assets using betas of sub-assets. So beta of the debt, beta of the equity, and we can estimate the fraction of those assets to estimate the asset beta. And in this, we have an illustration. So for every beta, assets, equity, debt, we have some expected return that we can estimate directly. And the alternative way of approaching the same exercise of estimating the cost of capital would be working with the beta coefficient. These examples. And the point that we started from, that different types of activities, different projects might be discounted differently. More risky projects should have higher discount. The beta coefficients, so we can also recomposite the beta of the revenue, beta of the fixed cost, variable cost of the assets, in order to illustrate the dependency of the risks to the fixed cost. So here it's important for us that we can illustrate the good point that will be presented in that the higher the fraction of the fixed cost firm has, the more risky its activities are, because the fixed cost, regardless of the performance of the firm would have to pay the same cost. So this can be the problem with some mortgage business. So if you rent the flats, so you have quite stable cash flows, but you also have a fixed cost of the maintenance. And if you have less the number of the, and also mostly real estate business is also highly connected with the banking industry, and they usually have a lot of debt obligations. And then you have a lot of debt, you have a fixed costs of the interest payment, and if things go bad, you have reduction in the revenue, you are more likely to go bankrupt, so you are more likely to become unable to service your debt, and therefore fraction of the fixed costs is an indicator of the riskiness of the business. Here we consider multiple ways of making adjustment for the risks. We can make a simplified scenario analysis here by considering probabilities of different outcomes to estimate the expected present value. And also what we could do, we can add so-called the fudge factor in the discount rate. So we expect to have some risk, and therefore we increase the discount rate, in this case by 10%. The problem with such way of estimating the risk is that it penalizes the distant cash flows severely, and when we consider long-term cash flows, it might result in a biased estimation of the present value. And that is why, if possible, it's better to consider the risk in the cash flows rather than in discount rate. But it is not always possible. So mostly for systemic risks, we have to make the correction into the discount rate, but we do it classically, we do it using the capital asset pricing model, and then adjust it for the cost of capital of the whole firm. When we estimate the risk, the general strategy is to identify different types of risk and make some adjustments in our cash flow estimation, but beware of estimating the same risks multiple times. So, for example, you might plan to have insurance against, or have some hedging against exchange rate risk, then you shouldn't include it in, for example, arbitrage pricing model when you would estimate the return. That's the one that goes to the discount rate. Also, in this topic, we discussed the certainty equivalent. Certainty equivalent is a synthetic tool to estimate the risk. Certainty equivalent is a cash flow that after discounting on the risk-free rate would give us the same present value as we have in our estimation. The principle here presented on this slide. So we have some nominal cash flows, then discount them and have the present value. And working with the concept of certainty equivalence, we do it by two steps. First, we make so-called haircut for the risk, then discount for the time value of the money. So haircut for risk. After that, we have a certainty equivalent, and then discount on the risk-free rate is just the discounting for the time value of the money. Example of estimating certainty equivalence. Good. Capital budgeting. Yeah, this is the topic that you got more familiar working on the second homework. In this case, we discussed first we started from the capital investment process, then we considered multiple tools to estimate the risks of the project that we briefly discuss. So first we started with presenting the principle of considering the project within the corporation. So the general way it's organized, there are some subsidiaries that have initiatives on the new ventures. They present appropriation request. Then, depending on the availability of resources, the firm would make a decision which projects to choose for investment. It is like one temptation that you might have: choose the projects that offer highest return, but we discussed that it is not the best strategy because projects that might have the highest return on paper actually might be not that good. The better way is to spend some time analyzing the project more in detail to make sure how risky it is. And there are some tools to do that we used in this, that we discussed here. Sensitivity analysis. It is an estimation of the change in the variable of interest that is a result of the change in some independent variables. So, for example, the change in net present value resulting in a 1% increase of the costs of the raw materials, or the prices of our product. Important thing to keep in mind that sensitivity analysis, we always change only one variable. If we change two variables in our model, for example, price and costs of raw materials, it is not sensitivity analysis already. Importantly, only one variable we change, all others must remain the same, because the point of this tool is to estimate the effect of different variable on the final result of the project, on the result that we are looking at. And therefore, the change must be on a single variable. Scenario analysis is an alternative tool. In scenario analysis, unlike sensitivity analysis, we change multiple variables. We can change single one, but mostly we work with the multiple variables. And here, when we consider scenario analysis, important to build some set of values of the variables in our economic model that are well, by their meaning, that are well aligned with each other. So saying that if we have a reduction in the price of raw materials, usually we are more likely to have reduction on the price, for example. And some macroeconomic factors like exchange rate might result, so increase of exchange rate might result in increase of the price of raw material and so on. Important there is to correctly consider interrelation between the variables in our economic model. Break-even analysis, the analysis of the, usually we talk about the level of sales, but not necessary. So value of these variables, then company breaks even, meaning breaks even means that the profit or net present value getting to zero. So it is a minimum value of sales that makes our profit or NPV equals zero. So the higher level of sales, meaning that company is getting profitable. And in this topic, we had multiple examples that we do not have time to repeat again. They are presented in a course book, so you can revisit them one more time, but also you yourself worked on this on the second homework. So I assume that you're already well familiar with that. So break-even analysis might be by profit, might be by NPV, and naturally the value of sales to break even by profit or by NPV would be different. And here, going back to the previous topic that we have, we talked that level of the fixed cost determines the riskiness of the business, and the sensitivity of the profit to the fraction of the to the sales depends on the fraction of the fixed costs. And in order to estimate the sensitivity of the profit to the changes in sales, we use the degree of operating leverage, and the formula is presented on this slide. Good. Okay, we have half an hour for 5 topics. Some of them take more time, some of them will take less time. Capital budgeting 2. In this case, in this part, we talked about some general ideas about the competitiveness and estimation of competitiveness, of competitive advantage. And also we considered 2 tools of the capital budgeting, 2 tools of risk management. There are some preliminary ideas that investment part of the activity is the main one. The financing part of the activities are supplementary. So, but still, both of them are very important. But the part that generates the profit is investment part. The financing part is some part that might generate costs, and cost would be can be too high if financing part isn't done correctly. And here we consider mostly investment part in this topic. Positive NPV means that firm have the sustainable competitive advantage, and like how to achieve sustainable competitive advantages is something that you would learn on your managerial courses. And for us, it is important to discuss the tools that we estimate to identify the competitive advantage. Examples. The examples of the forms, but yeah, this is one of the estimations that we would work. So the principle there was to estimate the cost of capital first. So how much it is worth for us, the capital, how expensive, so what costs we have by having this capital in use for the firm, both direct or opportunity cost of capital, and compare it against the return of our firm. There are several estimations that are related one to another. Here we have a slide with net return on investment. It is a difference between return on investment, so profit divided on the assets invested. This is return on investment. And the cost of capital, something that we discussed with you already today. And extra profit that we have, so excess return, is called the net return on investment. And if it is positive, it means that the firm has some competitive advantage to offer, has some competitive advantage. Alternative way, probably this is one of the most famous estimation of the competitive advantage. It is called residual, or excuse me, economic value added, it's called. The principle here is the same one is that we just discussed in the net return on investment, but instead of estimation in a percent, we have estimation in monetary terms, in dollars, rubles, or wherever currency you work with. But principle is very much similar. So we have profit that firm generated. We subtract the cost of this profit by multiplying the cost of capital on the total assets of the firm. The difference would be economic value added. So this is the results that we achieve by having the superior performance over the competitors. Economic profit, it is also quite similar, just make the focus on another areas. So we have a return on investment, the one that we discussed, minus the cost of capital, and multiplying the capital investment. This will be also monetary estimation of the competitive advantage. Economic value added is additional estimation of the company performance that we can do on top of the accounting estimation in order to estimate how competitive the firm is. It has some advantages to look, for example, it motivates the managers to focus not on the accounting value, but on the real competitive position of the company. But it has some disadvantages, rewarding for the quicker paybacks, ignoring time value of the money. So it has both advantages and disadvantages. But still, it is a good estimation that we can have on top of the accounting estimation to see how our firm performs. Then, in this part, we discussed two tools of the capital budgeting: decision trees is and also Monte Carlo simulation. Let's talk one by one. also familiar to you by your applied project that you completed. Therefore, we will discuss them briefly. Decision tree is a way of presenting sequence of decisions or points of uncertainty, and it is good that it allows the company, it is a tool of strategical planning. It helps companies to determine points that will make the critical choices, also estimate the value of the information, and good tool to make the link between the different steps in the economic process of the firm. Here are simplified examples, and decision trees consist of four main types of four main components: decision node, event decision node, point where we make a decision, event node, point of uncertainty. After decision node, we have decision branches. After event node, we have event branches. Event branches has some probability because there is uncertainty, and we somehow estimate what can happen, and we estimate probability of each event that might occur. On decision branch, there is naturally no probability because it's a point where we would make a decision. And real options are the tools that we use in order to estimate the value of the information. There are different types of options, so we can make some steps in order to have opportunity. And this way of approaching managerial objectives is called the real option. So, for example, we can rent some production facilities in order to be able to increase production volumes if necessary. In this case, it is called the production option. So, to have option to produce more if necessary, and so on. So we can somehow secure opportunity to sell our equipment if we do not need it. This would be the option to abandon the project. And good tool to think about such options, real options, is the decision trees. Is a decision tree. Here is an example of decision trees and the way we work with it. So we draw it from left to right or from up downwards. Then we estimate it backwards to see the result at each node, to see what decision we should make at each node, at each decision node, or estimate the probability on the event nodes. And Monte Carlo simulation, the principle there is that we have economic models like we had in previous tools that we consider. Then we estimate the probability of the distribution of some variables within the model. And then we randomly generate those variables according to the predetermined distribution. Every time we generate, we have different variables, we would have different net present value. Then we replicate this process 10,000 times and have some distribution of the net present value. And we use it in order to predict the results that we'll have in our project. Good financing decision now. Financing decision I told you that investment decisions generally are more important. It's the core of the business, but financing decisions are also worth considering, because if they must be done right in order to reduce the risk of the operation, so make sure the company always have enough money for its operation and company does not overpay for using the assets that it uses. In order to estimate the value of the financing decision, we can work with the same tool. We can work with the net present value, but the sequence of inflows and outflows is different. When we talk about investment project, first we pay something, so we invest something first, then we receive money back as cash inflows. Talking about financing decisions, the situation is opposite. First, we receive some money, we either receive loan or we receive equity financing, and then we pay those money back as interest payment or dividend or wherever costs we would have. So mostly it is easier to illustrate on the debt. When we borrow some money, then we pay it back. And if we somehow borrowed money cheaper than the currently available, then we have an additional net present value from the financing decision. Here is an example. So there is some market rate. We somehow, maybe it was a special, it can be kind of the support from the state to provide loans at the subsidized rate. Then we would have positive NPV of financing decision of this kind. This is the structure of the monetary flow between different institutions on the financial market. Corporation has some money, generates profits, can reinvest. Other institutions work as mediators that would give money from investors to the corporations, and investors themselves also are looking for the profit, so they give those money to financial intermediaries or invest them through the financial markets, and this is how the economy functioning. Here we have multiple examples. We have general example of the investor that would give money to the bank or insurance firm, and this firm, bank or insurance firm, would give money to the other company. There the profit would be generated, so the financing might go multiple steps before it achieves the company that need those money for its activities. There are multiple tools. We discussed also the random walk theory, the theory of predicting the price of the stock. More accurately to say that the theory says that in the short term we cannot find any pattern of the movement of the stock price. Here is the illustration of such idea, that there is a Standard & Poor's and there is a coin toss game, and it's difficult to say which chart represent what. This is the thing, and what is important there in the movement of the stock prices is the information. Is a key component, key factor that affects the changes in the stock price, in the assets price in general, because the results of the firm would affect its price. Also, important there is how fair distribution information is distributed among the market participants, and depending on the fairness of the information distribution, we can identify different levels of the market efficiency. So efficient market, it is about the distribution of information on this market. We call market efficient when information is fairly distributed among market participants. And of course, naturally, there are some deviation from this, and therefore there are three forms of market efficiency identified: that weak, semi-strong, stronger form of market efficiency. So those are the different levels of the fairness of information distribution. And there are some ways to estimate the abnormal return. So this is the abnormal returns are usually the results of the some new information appearing, or maybe some arbitrage opportunities that some investors size. This is the way information new information can affect the price. So in reality, like step by step, some information might be known by more and more market participants, and they would trade again along to this information. And in this point on the line, here the information is getting public, and then after it became public, the price would stabilize on the new level based on this new information. No, and there are some particular firms that try to benefit from informational advantage. They're called active traded fund. They are not always able to do this because they charge quite high commissions for their services, and with higher commissions they have to compete against market average, and it is not always they are not always successful there. And so far we discussed only rational investor there, so that try to maximize the profits. But in the second half of the 20th century, there are findings of some prominent researchers who subsequently received Nobel Prize for their finding, and their finding states that the people in their behavior quite frequently deviates from the rational, from the fully rationality, and there are some systemic deviations from this full rationality, complete rationality, and the behavioral finance is an area that studies such behavior. So there is such patterns as a loss aversion or mental accounting, and this is some tools that people systemically deviate from the rationality due to the behavioral patterns. Also here we discussed the voting procedures within the firm. Please look at, there are two main types of voting procedures, cumulative and majority. Here are examples. Please pay attention to the difference between those two. also we discussed the fraction of the how the fraction of the debt might affect the company performance, and there are particular ratios that we use in order to estimate that. Also, factors relevant for the financing are the risk of default. In order to estimate the risk of default, there are ratings. So there are rating agencies would estimate the risk of default of different issuers of the bonds or just companies in general. And the more risky the firm, the more likely it to have a default, the higher coupon or interest rate such firm has to pay. Yeah, so here are some other alternatives to the debt, which by its essence are the same, just they are issued in a different procedure. Here we discuss the venture capital financing, because when we talk about the small startups which are highly risk, they are not able to borrow the money from the bank because they are too risky, and investment they receive as equity financing at the first stages, and there are special patterns there. So we have some estimation of the firm value initially, then new investor would buy some fraction for the amount of money, and as the firm expands, the value of the firm goes down, and venture investor might profit substantially. And the process is that first we have some estimation of the firm, investor buy some fraction, it has initial value, firm increased, investor would have more, have value of its, his investments increased as well. And as the firm matures, it can go public, and then there is, it's called initial public offering. Then the firm sells its shares to the on the open market. There are just multiple factors associated with this procedure as well. Something that you can revisit preparing for the exam. Good. Here what we have. Yes, now I have to cover it quite fast, but no, there are just few focal points that I would mention there in the payout policy and capital structure. Let me cover them. So first, here we discussed how the dividends are paid. Beware that there are multiple steps in this process, not just in a single one, announcement, payment, and the sum they are distributed in time. Information, dividend, their company makes a decision about the dividend by considering multiple factors, not only how much money is available, but whether it will be able to sustain those level of dividend, because dividends themselves have information content, so they send a signal to the investors as well. Here we discuss that there are different perspectives on the investments, on the importance of the dividend. There is this perspective that it is irrelevant. They suggested by Miller and Modigliani this perspective. The irrelevance of the dividend can be proved in this point, but important to mention that these theories, they have a condition that all like both dividend and other types of financing, they are taxed in the same way. But if it is done in that way, then they argue that it is irrelevant how firm would use those money, either pay dividend or use them in their operation alternatively. Here we explain the split of the stocks. So first you have some fraction of the stocks. If new stocks are issued, then you can then the value of your stocks would get lower because there are more stocks issued. There are alternative theories that that would consider the taxes, that would also argue that return would be the same. Naturally, there are different types of investors, that some of them more interested in the dividend, some of them more interested in capital gains, and it might affect the financing result for the firm of those different types of financing strategies. Taxes is also relevant there. We discussed the imputed or traditional taxation mechanism of the dividend. The problem there is that corporation first pays corporate tax, then as an investor you pay tax again. In imputed system, those two payments are adjusted. In traditional one, it is just taxed 2 times. Depending, if firm grows fast, usually it doesn't pay dividend because it can reinvest itself. But if firm is well established, it's more likely to pay dividend because it has less investment opportunities to use money effectively. And another important financing decision refers to the debt strategy. Also, there are different perspectives on the importance of on the whether debt strategy is relevant or not. There is one line of thought that instead of borrowing firm itself, the investors can borrow and invest more money into the firm. And then, so for investors themselves can replicate financing structure, and therefore the firms doesn't have to make any adjustment in their financing structure. And this idea is illustrated in the examples that we discussed in this part of the lecture. Yes, so this is some example that illustrates that. And this is the theories that weighted average cost of capital, the one that is already familiar to us. And this is something that we keep on returning, and we use it in order to estimate the actual result of the different financing structures of the firm. And in different debt equity ratios, so we would have different weighted average cost of capital under some assumptions. So naturally, the more you borrow, the more expensive borrowing gets, and the higher return of equity your investors would request, and therefore there is this perspective that after tax weighted average cost of capital would be quite similar to the return on assets, which is also something we use to estimate the opportunity cost of capital, because the cost of debt would be compensated by the cost of equity. Derivatives. Oh, we ran out of time. Okay, I would do this very briefly. Derivatives are the instruments that are issued based on other instruments that are there are primary instruments and derivatives, so they are derived from those basic instruments. There are the most famous one are forwards, futures, and options. Forwards are individual contracts. Futures are market traded contract to buy or sell some assets at the predetermined price. An option is also market traded contracts that provides opportunity or right to buy or sell underlying assets in some period of time. Two main types, call or put. Call is an option to buy, put is an option to sell some assets. Yes, so if someone has a right, another side of the agreement would have an obligation to do this, and most time on this class we spent to discuss the strategies of the option estimation, price of the option estimation. And we discussed that we can replicate option with alternative financing, with combination of some financing tools, for example, borrowing money, go short on some assets, lending money, buying long some assets. And with this principle, we estimate the price of the options. This is a call pool parity that is very useful for us because we can estimate the value of the call option and directly from this estimate the value of the put option. Yes, so here, please, these slides, information from these slides are very likely to be included in our final exam. So you should understand how the changes in different factors affect the price of the option. And all of them can be derived from the formulas of the option estimation, option price estimation. And here we approach, so there were two main principles that we discussed there, two main tools. It was the first one was called binomial pricing model, and the second one was the Black-Scholes pricing model. So here we illustrate the binomial pricing model, then we estimate the potential change in price, the likelihood of those changes. There are formulas for this estimation that we present. We have them here, the formulas for the binomial pricing of the option. They are basically depends on the expected return, standard deviation, and the interval and the time period that we work with. Then we can estimate everything directly. Not expected return experience from the interest rate, standard deviation, and the time period. From them, we can estimate all variables. We need to do the binomial pricing, and we draw simplified decision trees in order to estimate them. And there is a the more steps we make in the decision tree, the more accurate our estimate, or in the binomial pricing model, the more accurate our estimation of the price would be. And there is a radical point when we have infinite number of infinitely small steps in building those trees for the binomial pricing. And this, in order to estimate option price in this case, we use the formula of the Black-Scholes pricing model. Here it is. Repeat the way we estimate it. In order to estimate it, we need to have some Excel spreadsheets, because we have the cumulative distribution there that is difficult to estimate without Excel. But I believe you also practiced that working on the score. And also the value of option is a good sign of the risk on the market. And here we have the VIX is the index of the options on the S&P 500 index, and we can see that it is very well aligned with the previous crisis that took place. This is a way after we mostly in these models, Black-Scholes or binomial model, we work with the call option price, and then we can derive the option of the put price of the put option using the put call parity. If there are some costs associated, if you want to be precise, you would include carrying costs of the option for the period that we analyze. And the final class that we had was devoted to the international corporate finance. There we mostly talked about the factors affecting exchange rate. Now, first, important, beware to avoid errors in describing the exchange rate. So what we mean by exchange rate goes up, exchange rate goes down, because depending on whether we talk about direct or indirect notation, those would mean opposite things. More accurate to say one currency appreciated against another one. So then we avoid ambiguity. Connection between the we have a spot price and forward price of the currency, and this reflects the expectation of whether currency is likely to appreciate or depreciate. The formulas for those are on the slide. Yes. Here is the main slide of this lecture, of the lecture devoted to international corporate finance, that there are 4 factors that are related and that reflect the exchange rate of the firm. We have an interest rate parity, we have an interest rate, we have inflation, we have spot exchange rate, so it's exchange rate in the moment, and we have a forward exchange rate. And they have the parity with each other, which is presented on this slide, and the rest of the lecture we discussed each of those parity more in detail. Finally, we consider, so there are multiple tools in order to estimate whether the currency is underappreciated or overpriced. For example, Big Mac index. Also, there are some another empirical evidence of those parity between exchange rate and the purchasing power, so the change in inflation. So final important thoughts of this topic was that building your international financing strategy, it would be good idea to keep the costs and revenues in the same currency. If, for example, you have more operation globally, it's better to have more costs in the regions where you generate your money from, because then your profit in those currency will not be affected by the currency exchange risks. Therefore, it will be more stable. So like asset and passive side of the balance sheet, also better to keep in the same currency, like borrowing money in the same currency at which you have your profit. And here we have an example on the different investment or different investment options in different countries under different financing schemes. And if you have some option that have higher return in one currency than in another one, note that exchange rate changes might affect the results of your investment and make the adjustment of the project accordingly. Good. This is the brief excursion on the topics that we discussed during the course. Thank you for participating. Now, these days we already can meet in person, so feel free to visit us, and you will have the week of the seminars with Vladislav. There you will also discuss some of the topics that we have. I liked working with you. Nice to meet you. Hopefully we will have some opportunities to work on the different projects together. If you have questions, let me know.
I have a question about, so we have an exam on the 8th and on the 1st April, on the 25th of March and on the 1st of April. So we have 2 dates of the exam.
No, there is a main one on the 20, when we have it, on the 28th, I think. Yes, we settled it.
No,
29th.
29.
Yes, on the 29th we have an exam, and the second date is a reserve date. As we conduct exam electronically, so we'll use the same tool. So we how it's called, Examos platform. We'll use it there, and according to the rules, we have to provide you opportunities. So if you won't be able to participate by any reason in the by any valid reason in the exam, then you will have opportunity to write it on the reserve date. But if you just skip the first date, no, it is just absence. Yeah, so you should so you write exam on the 29th. Yes, the topic includes 7 to 14. Inna?
No, just thank you.
And the example of the final exam, I think Vladislav shared with you already, so should be available.
Yes, Vladislav shared.
Vladislav shared. Good. Anything else? For the, you're already familiar with writing exam in Examus. Make sure to use the correct browser. If possible, try to go to the place with a good internet connection, the stable one. So good luck with that. I hope you will be able to improve your results on the exam, but still, you should make some effort to complete the course successfully. Good. Okay, now we can complete the meeting today and see you in the future.
Goodbye. Thank you.
Goodbye. Bye.
Goodbye.